So,
hello, everybody. This is Eugene, Coldwell Banker Real Estate. And in today's topic for What Is, we're going to talk about mortgage. And specifically for that, I asked our mortgage professional, our expert, and part of our team, member of our team, Sal Tomaselli, to help us. You may say, hi, Sal. You may say,
hi, Eugene. Thank you for having me. Thank you for having me on.
Absolutely. I just wanted to say that probably very few people don't know about mortgage, but how many actually know enough to be able to make a decision or ask proper questions when it comes to financing. So again, this is why we came to Sal and ask him, please break it down into pieces, explain us what it is and how to deal with this when the time comes. Thank you.
Absolutely. Okay, well, Eugene, thank you for having me on. I appreciate it. I'm very honored to work with your team at Coldwell Banker, so thank you. And I'll give you guys a little background. I'm the owner of Professional Mortgage Solutions, which is a mortgage brokerage firm. We're located in Rego Park, New York. We're licensed in New York and Florida. Basically, I've been in this industry for the last 35 years. And to very basically, to answer your question, what is a mortgage? A mortgage is very simply an agreement between you and a lender that allows you to borrow money to purchase or refinance a home. That's really simply stated the the easiest explanation of what a mortgage is. And when I do training for my loan officers, I basically break it up into 4 boxes, and I break it up into, so banks look at basically 4 quadrants, and the quadrants are your income, your assets, your credit, and the collateral or property type. Okay, so those are basically the 4 fundamental boxes that lenders look at. And if we take each one of those individually and break it apart, delve into each box individually, your income, lenders are going to look at your income and they're going to determine how much you could afford, based on your income on the property. And the income also takes into consideration, let's say if you're buying a multifamily, a 2-family, 3-family, 4-family home, it'll also take into consideration the rental income that you get from the property. So it's not only your income from your employment, and employment gets broken up into basically 2 buckets, which is W-2 income, which most people are salaried and W-2, and they get a weekly paycheck or a bi-weekly paycheck typically. And then we have clients that are self-employed clients that are they're self-employed business owners, and they get looked at slightly differently. We can delve into that further in a different session. But basically what lenders do is they look at your income, and then they have a formula for how to calculate your income to determine if you can afford the house that you're looking to purchase. In addition to that, the banks also look at your assets, and they look at, do you have the money to purchase this property? And lenders look at, do you have sufficient money for the purchase, as well as possibly some reserve funds, just in case, they don't want you to have $10,000 saved, for example, and spend the $10,000 on the purchase of the property and then be left with no money. So they also look at your reserve capability. Do you have assets And there's all kinds of rules that surround assets and, which type of assets are acceptable and which are not acceptable. And again, we can go into, delve into a more detailed, deeper dive on assets. So far we have income and we have assets, okay? The third box that lenders look at is credit. And they say, do you pay your bills on time? And when lenders assess credit, they look at your ability to pay and your willingness to pay. So there's two components
What do you mean
that
by
lenders look
willingness?
at. Well, do you pay your bills on time or do you pay your bills late? Okay. And so if you pay your bills late, that'll be reflected on your credit report. And I think most people understand that they have something called a FICO score or a credit score. And there are many models for credit scoring. The mortgage industry has its own credit scoring model. So sometimes if you go to, Credit Karma or Experian, you'll get a score. In the mortgage industry, we look at three scores. We look at the score for Experian, Equifax, and TransUnion. So we take the middle score out of those three scores to determine your eligibility for obtaining a mortgage. So it's a little more involved because a mortgage is a bigger purchase than a car or a credit card or whatever. So when you're looking for mortgage financing, the lenders tend to do a little bit of a deeper dive. There's different criteria that's involved in mortgage financing. So they'll look at your credit a little more objectively. But getting back to ability to pay and willingness to pay, they're looking at your ability. Do you have the income to make the payments on these credit cards and these debts that you have? And that encompasses car loans, student loans, credit card debt, maybe personal loans. All of that gets factored into the equation when you're qualifying for a mortgage. And lastly, the lenders look at the collateral, the property that you're buying. Okay. What is the type of property that you're purchasing? Okay. Is it a one family? Is it a two family, a three, a four? Is it in sufficiently good condition? So there are lenders that have or segments of lending that have standards. There's conventional lending that looks at a property one way, and then there's government lending like FHA, and they have slightly more stringent guidelines on the properties. So basically, lenders look at the property. They're going to look at your credit. They're going to look at your assets, and they're going to look at your income. And those are the four pillars that lenders look at when making a determination as to whether they're going to lend you, give you a mortgage on the property. So hope that answers your question.
Oh, well, to start us, yes. Thank you very much for that. I just wanted to ask you one more question. When people see like today's interest rate is this, today's interest rate is that, like 7.5, 7.8, 7.3, whatever. Does that mean that this interest rate is one for everybody, or how can people associate themselves with this number or another number? Maybe?
Okay, so that's a great question. What the lenders have done and what the government has done, so you may have heard of Fannie Mae and Freddie Mac, who govern or who sit on top of the lenders and create guidelines for lenders to lend against. They've incorporated, and this is something that's been around for many years, but they've incorporated something called risk-based pricing. So if your credit score is lower, they're going to charge you a little bit more. If your credit score is higher, you're going to get a better interest rate. If your down payment is lower, so if you're putting down less money, you may incur a slightly higher interest rate.
Mm-hmm.
That's not always the case, depending upon the program that we go through.
Mm-hmm.
But if you're putting down a substantially large amount of money, 20%, 30%, 40% down,
Mm-hmm.
the lower the risk for the lender, the more attractive the pricing they're going to give you. So when you hear rates being quoted, 7.25, 7.5, whatever the rate is and whatever the market is at the time, it really doesn't apply to every person across the board. So there's going to be some variation based upon your credit, your down payment, the type of property you're buying. So lenders have determined that a one family owner occupied home is far less risky than a 3 or 4 family property. So there's going to be better pricing based on a one family property.
Mm-hmm.
So everything is really tailored to your specific situation, So it really, I would say that, the rate that's being quoted or that you hear that's being quoted in the marketplace is a ballpark rate.
Mm-hmm.
And when you dive a little deeper into your specific, the client's specific situation,
Mm-hmm.
depending again on their interest rate, the property type, their credit score, those factors will govern, it will change the interest rate either up or down depending upon what the client's situation is. Now it doesn't change by much. I mean, it could change, by 1/8%, 1/4%, up or down. But that's why, I highly recommend that, before a client goes to start looking for a home,
yes,
that they get pre-approved for a mortgage, walk into your office or a realtor's office with the pre-approval,
yes, mm-hmm.
which gives the realtor, kind of a ballpark as to, what a client can qualify for, what the person qualifies for. And it really answers a lot of questions for the individual as to, what their real interest rate is going to be, because there's so many factors that drive, the rate either up or down, so it's very much an individualized, situation with the lender. So I would say my best advice is to get pre-approved as quickly as possible.
Mm-hmm.
As soon as you enter the the market and start shopping for a mortgage, because that'll really give you a lot of clarity as a homeowner or as a somebody who's going to borrow money, as to what kind of terms you're going to get from the lender.
And obviously what kind of money you can get for your purchase as well.
Correct. The amount of the mortgage, and there's many factors that cause that number to go up or down, depending upon where you buy. The taxes. If you're buying in the 5 boroughs of New York City, the tax base is significantly lower than if you go to, for example, Nassau County or Suffolk County or Westchester County. So as you move, when you're looking in various locations, even the taxes that are being charged are going to affect your ability or the amount that you're going to qualify for. Right. So these are all important things when you start to look for a home. You want to look for a home. When a client comes to me and I ask them, where are you looking? If they tell me they're looking Queens or Brooklyn, I'm going to plug in an average number that's typically lower than if they tell me they're looking in Westchester County or Nassau County or Suffolk County. So we kind of hone in on that, because that's very important, because the taxes in Queens and Brooklyn could be $6,000, $7,000, $8,000 a year, and maybe $10,000. And if they go to Nassau County or Westchester County, we could be talking about taxes, $16,000, $18,000, $20,000. So it significantly changes the amount that you can qualify for. So it's important to know, to hone in on it, on an area that you're looking for.
I got you. Okay.
So hopefully that answers your question.
Absolutely. Thank you very much for your time. Thank you much for this information, and we'll dive even deeper next time. Okay.
Thanks, Eugene.
Okay.
Pleasure.
Thank you. Have a good day, Sal. Have a good day, everybody. Bye.